let's look at those, and how do you know when to exit and risk. Now, one of the biggest problems I've always mentioned to you all is people don't know how to buy stocks. Okay, this is what most people's portfolios will look like, either through a fund manager, an IFA, wealth manager. I mean, basically it's spray and pray. Just buy a bit of everything so that you can. If a fund manager does it, they do it so they've got something on marketing literature to tell you each month and say, oh, well, this one went well. Well, of course it did, because you've got every single bloody stock in the market. One of them's bound to do well, isn't it? And if it's private investors, they do it because they've got FOMO. Others, it's completely empty. And the reason it's completely empty is because they just don't know what to do. And they don't know that all you do online, the way you do online banking, you can do online stock buying, okay? So I'll explain that. Now, for me, I've shown this before, it's really between this number of stocks. Now, it's very simple. We have what we give clients is sort of a risk appetite diagram. And if you're more risk averse, you might hold more low volatility funds, exchange trade funds, okay, which, like, let's say a low volatility one, not necessarily the S&P 500, but something like that, okay? And you might hold more cash, maybe 20, 30, 40% of cash, maybe 2 years requirements of cash. Okay, that's if you're more risk. If you're more risk loving, like a 20-year-old, you're probably going to have closer to this number of stocks. The reason fund managers are so rubbish at their jobs is, first of all, they spray and pray. That's one reason. Okay, they just hold a bit of everything. There's a whole bunch of technical reasons, one of which is they're in the business where they're paid by assets under management. So they maximize the assets under management because they're paid fees on that. So they want to get, say, $1 trillion of assets under management. And therefore, they've got to put money into a lot of companies. Otherwise, they'll end up taking over some of those companies, and they don't want to be doing that. Now, that's not your problem, and it shouldn't become your problem. It'll be a nice problem to have when you've got $1 trillion yourself. But if you haven't, why is their problem your problem just because you've outsourced your retirement and your kids' inheritance to a muppet like a fund manager? Instead, what to reduce that problem you should be looking at is somewhere along there. Now, the mathematics behind it, if you want to go into it all, the work by Eugene Fama in particular is good. He's an economist. He won the Nobel Prize in economics for pointing out how bad fund managers are and why they underperform the market, and showing the mathematics of why they must. One of the other reasons why they must underperform the market is they're picking from a very narrow gene pool of stocks. They might have a UK fund or a growth fund or a value fund, but why don't they have a global, I'll just pick the goddamn best undervalued high growth companies? Why don't they do that? Warren Buffett does that. Okay, it just so happens the global best valued, unvalued high growth companies he keeps picking happen to be American. He's got one or two Chinese ones, but generally, you know, when they asked him, why don't you look at something in the UK? I think he looked 15 years ago at Tesco and then thought, no, can't find